Well, US and Chinese growth concerns are colliding with a cooling US labour market, and the market's asking how far are the Fed behind the curve? And if we have a look at US interest rates, which we touched on in the trade-off, we said that the market's aggressively pricing rate cuts coming through. Obviously, in that environment, we're seeing the US dollar finding few friends. That's not the case for the Japanese yen, which is in beast mode at the moment. We're seeing crude being absolutely chopped up. A lot of different variables playing through, which we discussed there. We have a look at what was happening in the AI trade, where the wheels look like they're falling off at the moment. It's time to get in front of the screens. This is the trade-off. Well, hello, Chris Weston from Pepperstone. I'm joined in 2 seconds by Blake Morrow from Forex Analytics. We're going to be discussing the various factors that are going on in the financial markets, this changing dynamic that we're seeing in our trading environment, the changing market environment that we all need to be adaptive to, whether that's our strategies which fit that, whether it's the change in risk management approach or position sizing. But we need to be dynamic, we need to be open-minded, and I'm going to bring the Mr. Open-Minded man himself into the programme. Blake Morrow, how are you, my good friend?
Hey, what's going on, Westy? Welcome back.
Hey, yeah, I was out in Dubai just talking about AI in trading and the future of trading and how we can use it effectively. It's an interesting world, Blake. I think we look at the world where it's been full of engineers and they've sort of come over to the investment side and set up quant funds, people from IBM moving over to investment funds and hedge funds. But now the opposite is true, people like us moving over to that world because, generative AI and ChatGPT breaks those barriers and we can remove emotion, become completely objective. Something we'll talk about on another show. But I find it just a fascinating world how we can, look at that. And for me, charting becomes irrelevant in the future. I just completely believe that you're looking at charting is going to become completely irrelevant. Charts just become numbers. Why if we're looking at charting and we're trying to understand these patterns of behaviours and repeatable behaviours that can leave a probabilistic situation going forward, we can just ask the system to tell us how many of these patterns, how many of these price actions we've seen and the probability of it occurring going forward in a split second. That's something we can debate in the future. Maybe another show. Blake versus Weston.
I'm up for debating on that just because I, as a human being, which you are one too, as far as I know, having that visual reference, I can't imagine letting go of that. But then again, my grandparents, I don't think they probably could have let go of the idea that they had to use a landline as a phone at some point. So,
yeah, very nice. But yeah, one for a show. We're gonna debate the future of AI Westy versus Blake, but it'll be a good one. Anyway, let's go into take the market pulse and see what's going on in markets. Right, Blake, lots going on. It's just I sort of came into the beginning of the week thinking that the equity is going to break new all-time highs. We saw a bull flag on the Nasdaq. We'd seen S&P testing the top end of its range. Looks like wanted to go higher. We had the Fed put in play that underpinned risk, and things were looking pretty good, right? Obviously not the case. That couldn't have been further from the truth in that situation because obviously Nvidia had that nearly 9.5% down day, biggest loss of market cap ever, and people are talking about other AI plays which the wheels have been coming off for a while. Supermicro has been selling off hard since March, but you can expand that into other plays. We talk about AI in a second, but obviously the dollar's under pressure now. The yen's all the rage. Everyone's buying into the yen. It's dollar yen's coming under pressure. Yen, MEX, all those kind of currencies are working. The yen's working pretty well there. Volatility's pushed up. You've got the VIX above 20% again. People are hedging out their exposures, and the data flow's really coming on the soft side. So we were all really focused on the labour market this week. And then you obviously saw the ISM manufacturing numbers, Nvidia, the headlines about the DOJ looking to them on antitrust, and sort of just makes us think, like, why are we buying Nvidia? So talk to me about sentiment right now. As I say, I was sort of thinking that there was upside risk beginning of the week. Now I'm sort of just like, well, why buy risk when we've got payrolls at the end of the week? How are you seeing this?
Well, that's exactly it. And I need to reference the, Nvidia was a big deal and their earnings at the end of last week, but we still had a couple of days of trading before the market really took hold. And maybe it was a little bit of the end of month flows that kept the market supported, right at the very end of the week. And then obviously coming back on Tuesday, it's like it smacked us upside the head. But this shows you kind of how flexible you have to be. Seasonal trades are impactful, especially this time of year, and especially knowing what we've got coming in front of us. Last week, even though you were here on the trade-off show, we did discuss, between the political risks, between the overvaluations of the markets, the geopolitical risks, and the economic data slowing and everything else. It makes sense that the markets are kind of regaining their footing. Now, it's going to be really interesting at the end of this week, and we'll get into this when we talk about the NFP playbook and how you are going to look at it. But I want to ask you this question, because this is where we have to be able to be a little bit more flexible. The data, we're going to find out more tomorrow. Tomorrow is going to be a pretty big day for data in the U.S. anyway. We have ISM, ADP, weekly unemployment claims. We have I'm missing one.
It's the services ISM is the big one, I think.
Services ISM. I think I said ADP as well. Anyway, we have a lot of data points tomorrow that's going to kind of fill us in before NFP. But let's just say, for argument's sake, the data comes in weak. That's where you look at the markets and you go, okay, if the data is weak, do you buy equities because you're going to get rating, maybe a 50 basis point rate cut on the 18th, or do the markets just sell off because you're like, my God, the data is really weakening? And that's why we have to be really flexible and be more reactive at this point, in my opinion. But how are you viewing that as far as, flexibility?
It's a great question, because the fact is that bad news is bad news. Bad data is bad news for risk, specifically on the cyclical side. And I think it's not a really easy question, in the sense that if the data is driven by growth data, like we saw with the ISM manufacturing number earlier in the week, what you see you see all these kind of cyclical pro-growth plays coming under pressure. Industrials come under pressure in FX market, the Aussie, Kiwi, CLP, all these come under pressure. But like we saw yesterday, we saw that weaker JOLTS report, and it was the dollar that came off because it's kind of specific to the US in that factor rather than a sort of global growth thing. But I think the market doesn't want to see a 50 basis point. I think risk wants to see a 25 basis point cut, because you still get the cut, but there's less urgency, there's less need to do it. It's a reflection that the growth is better. So you do get a lot of people coming out and saying, 50 basis point cut, you're going to get Fed funds down to a neutral rate far quicker. But it's the reason why they're doing it that's a negative for risk. So I think the Fed want to be in a position to cut 25. That's the move they want to make. And I think the more risk positive situation would be that the economy is holding up okay, that they only need to do 25 basis points. The need to do 50 is bad, because that's when we start seeing earnings downgrades coming through, people chasing that equity coming under pressure. So the more risk situation is that you get economic data cooling, but not in any kind of worrying capacity. The Fed are cutting 25 basis points. That's the Goldilocks for risk. The need to cut 50 basis points is where the market gets a bit more concerned. So I think
it's the old porridge story. Not too warm, not too cold, just right.
Exactly.
That's kind of where you want your
day. So they'll go on. Oh,
I was going to say we probably need to move along.
Yeah, I was going to say really quick. I just want to talk about the NFP side of things, and we'll talk about AI in a second. Okay. But you've got 34 basis points of cuts being priced for September. So, 1 in 3 chance that they go 50, which feels about right. The Fed want to go 25. But, we're talking about the NFP playbook then, because, what is the number that gets you to 50 basis points in the market pricing?
For over 4.5, or excuse me, 4.2 in unemployment. I don't even really care what the number is, the headline number, because it's going to be somewhere, I would assume, between 100 and 180,000.
And it'll be revised 20 times as well.
Yeah, right, exactly. So the headline number doesn't matter so much to me, but it's really the unemployment rate. If that ticks higher above, we're expecting it to drop back down to 4.2%. If it stays at 4.3 or goes to 4.4, heaven forbid, you're going to see the dollar really come off. And I think the natural play, and it's going to be very binary with the dollar. I think if they're selling dollars, it's because the data's weak and the dollar yen's probably going to get smashed. And then if it's stronger data, you probably just want to sell the euro because the euro had weak, PMI or CPI last week. So I think the euro is going to be naturally the short there. How are you going to play the?
Yeah, I think you made a good point. I think the unemployment rate's key. Remember that the headline number is based off the establishment survey, where they go to businesses, and half the business don't fill it in anymore. But then the other one is on the household survey, where the unemployment rate's based on the household survey, where they go to households and ask them, have you got a job? And it can be more volatile because some people get 2 jobs. You might go and get a job at Walmart and get a job in driving Ubers or something. You've got 2 jobs, so it does become a bit more volatile. But I agree. If we were to see it 4.3, certainly if we were to see it tick up to 4.4, 50 basis point cuts done. I mean, I think that's going to be the default situation. But it gets a bit muddy if it ticks down to 4.2 and we get, say 180,000. I think the Fed would then probably just go 25 and start the proceedings on that. So it will be interesting. But I think with the payrolls number, if the unemployment rate ticks up to 4.4%, which is not expected, but if it was to do that, I think risk really comes off, and I think that would not be a good situation, because the market would say, look, the Fed are too far behind the curve. They need to chase their tail, and we need to de-risk. So it could get pretty ugly in the market if we were to see a poor payrolls number. There's so much. The Fed have really made us focus on this number so intently that all the news recognising algorithms, they're all myopically focused on it. There's so much. It could get pretty wild out there if we get a poor number. I'm not saying it's going to happen. I have no idea if it is, but if there is the risk that this is the risk that needs to be absolutely managed like the ninja. Anyway, go
on. Did we need to move on? Because I wanted to do we have to move on?
Yeah,
we do. Damn it.
We're going to get told.
All right.
I wanted to talk about AI, but we could have done a whole freaking section about AI, because it's just a crazy story. Like, I'm hearing the word bubble. I don't think it's a bubble, because Nvidia's earnings follow the share price, but let's touch base on that another time. Anyway, let's go to That's a Setup. Right, let's go to S&P 500, because I can talk about NVIDIA now. Let's bring up the chart.
I had so much to say.
So do I. I know, damn producer. Look, as I said, I go back to what I talked about earlier there, where, I went into the beginning of the week thinking, we've been trying this sort of tight range. We were testing the top end on Friday, and then boom, down she goes. We obviously had the US Labor Day holiday. I hope you had a great day on Monday, Blake, and for all the US viewers out there, I hope you do as well. But obviously then Tuesday came in, whether it was the September effect that everyone talks about. It's the weakest month for equities, volatility spikes in that time. Obviously, we had the NVIDIA news, and people de-risking on NVIDIA, and people looking at the whole AI space completely and saying it's just it's lacking a catalyst. The hyperscalers need to find that investment that the return on the investment they've been making here. I think this right now is trading below the 5-day exponential moving average. It's trading at bottom of the range. It's difficult with the technical side of things here, Blake, because it looks weak. I say right now, if you're to ask me where I think the probabilities lie, I'd say this setup would suggest there's probably further downside risks, but it's difficult to do. It all really hinges on the payrolls number. It's weak because people don't want to buy risk ahead of NFP. If we get a good number, you could see a really strong relief rally in equities. If you see a poor number, unemployment rate 4.4, even 4.3, jobs below 140, this could be trading sharply lower. So it is a binary effect, really. But right now, the market's going into NFP a little bit weaker, and looking to rotate into the really highly defensive areas, staples, utilities, and REITs to an extent, given the moves we've been seeing in fixed income. So difficult one to play it. You're just sitting on your hands and waiting for that NFP. I think the ability to wrap, but the setup there is not great.
Yeah, well, I agree with you, and it does things can turn on a dime, and that it's proved to us in the markets this week. My first setup, Chris, is going to be the dollar yen, and I've got to ask: is there another leg coming to the downside? I mean, you see, we were setting up like a triangle consolidation, but Ueda, he came out guns a-blazing already this week, and the fact that rate expectations in the U.S. globally, you could probably argue, but definitely in the U.S., those rate expectations are actually picking up for potentially a full 100 or a full basis point cut, 100 basis points full percentage cut, by the end of the year. And that divergence between the BOJ and the FOMC is definitely weighing on the US dollar Japanese yen. It only rallied to a 38% retracement back there near the 149.50 level. And I know everybody and their mother's brother's uncle's monkey was sitting there waiting for a good data to come out this week, hoping to get a short off somewhere near the 150 level. But unfortunately, I think we're going to be tracing it lower. And if data streams in lower over the next couple of days, I have a feeling, Chris, that we're going to be trading below 141.75 by the end of the week, especially if NFP's weak and we get all the ISM and ADP, everything else tomorrow. If that comes in weak, I'd be a little worried about being long the dollar yen. Anyway,
yeah,
I think that's a nice setup.
One of the big debates at the moment is about the US dollar versus Asia FX. And whether you're talking in China with all these exporters who've been buying dollar deposits over the years, and they've been looking to increase their hedge ratios and look to reduce some of those dollar deposits because the Fed are cutting. And then you've got Japan with the GPIF looking to reweight on its Japanese equities, and investment funds looking to pull capital out of dollar deposits. It all leads at the moment to a stronger yen, stronger yuan. Not less yuan, but certainly the yen is looking pretty attractive at the moment from that repatriation trade. I think is where we're going. So big debate there. Asia FX very much in focus as we're going there. Spot crude. I've talked about this. Spot crude. Let's bring spot crude up. Toxic mix. Why have we seen a toxic mix? Well, obviously the growth side of the equation is very much in focus. I mean, China is very much there as well. In fact, sometimes I think China's probably more important to the crude story from a demand perspective than the US. Although obviously we've seen some of the data there coming under a bit of pressure. But I think Chinese growth is clearly under the spotlight. Everyone's talking about missing its growth targets for the first time in a couple of years or so. But look at this situation. I mean, there's been lots of talk this week about Libya. There's been lots of talk about OPEC Plus coming out and increasing barrels in October. They've retraced that. The market doesn't believe it. But, maybe we get a pushback on them bringing barrels back to the market, but it's only going to be for a temporary period. It doesn't change the game. So toxic mix, increased supply with lower growth. We've broken the bottom end of that range. I mean, it's just such a big technical level. There's so much technical damage done to the crude market there. But we are coming down. You see that big sort of blue shaded area. Maybe the buyers step in if we were to pull down to there. There's definitely a scalp in there if we get down there. If it continues going down, bang, you'd look for a little bit of a mean reversion move there. But right now, Blake, the crude market and the copper market to a sort of lesser extent is telling us a pretty clear message about what's going on. There's no buyers in the market, really. It's been a seller's market all day long. And I'd be selling rallies in this.
Well, and that's why I'm going to bring up my last setup here, which is cocoa.
I'm in love with the cocoa.
Here we are at Triangle Support. I'm going to be the first one to tell you, I've never traded cocoa before. It's not something that's typically on my radar, but what's on my radar is the commodity complex. And you just mentioned crude. You mentioned copper. You start looking around, Chris, and some of these commodities are not looking particularly good, from a growth perspective. And you see this. We're sitting on this daily trend line, and this is your Pepperstone CFD. And the fact of the matter is, we start breaking below that triangle. Then you're at the 200 DMA. You get below the 200 DMA. You're below horizontal support there at 71.64. And next thing you know, we're going to have a very nice Valentine's holiday come February, because chocolate's going to be hell a lot cheaper, and it's going to be cheaper to buy those for our wives and loved ones. So, the fact of the matter, though, is that we are on triangle support. And if you're looking for a setup, this is do or die for the cocoa market. And I thought I'd bring it to your attention because it could get ugly,
Well, I hope so. I hope so. I'm looking to put some weight on. It'd be nice to go into Christmas with the ability to smash back some bars and have a cheaper price to pay. But obviously what we're seeing is the consolidation there. It's breaking down. I love those patterns, to be honest. It tells you clear view about how the market's sinking and where the collective weight of money's going. So, I think it's a great setup. Looks like it wants to go lower. I think the probabilities there are for lower levels. So get short. is my opinion. Anyway, let's go to play today. All right, let's go. Apple versus NVIDIA. Let's have it. Bring up the chart. Right, what we're saying is there's a pairs trade. I reckon Apple is going. I'm not bearish on NVIDIA to the extent that some people are. People feel that the bubble is bursting, if you want to call it. I don't think it's a bubble because earnings have moved up very, very sharply alongside the share price, unlike Cisco in the 90s where the share price went up, earnings went up. It's a margin story in NVIDIA. But what we now need to see is the next leg up for NVIDIA, which is these hyperscaler names, your Amazons, your Metas, your Googles, the guys who have invested a significant amount of infrastructure, being able to get a return on that. That's the next phase for NVIDIA going forward. But right now, there's all investors are saying, what's the catalyst? There's missing one. But it's Apple which really interests me now because they've got this. They've got the iPhone, and that's where it's going to be. This is where, Blake, we're going to be sitting there going, I want to book, Siri, book me I want to go to the dentist, book me and it'll come back and say, Chris, we've got an appointment on Wednesday or something. Do you want that? Yes. And it just becomes your personal assistant. The whole thing becomes that. That will be where we're going to go over the next 2 years. AI, something we can use. It's going to be. I think that Apple is going to be the king of AI going forward. It won't replace NVIDIA from a GPU perspective, obviously, but I think they're getting into this play next week. They've got the Glow Time event. They're going to really come into it, and it's going to be incremental gains over the next 2 years. But I think Apple is going to be the king of AI going forward. And look at the setup we've got here. If we look at it on a ratio, you can see that Apple is outperforming going into that Glow Time event. I'm sort of hesitant to sort of do technicals, but you can see that I think a break of those levels, I think you're going to see continued outperformance, I think, from Apple in the short term. So I like being long Apple, short NVIDIA. You could probably take NVIDIA out of it, maybe do one of the other AI plays because NVIDIA is still a high quality. But you've also got, on the regulatory side of things, people are a bit concerned about the antitrusts around NVIDIA. But we are seeing outperformance there. And I believe that Apple in the short term will continue outperforming NVIDIA.
You call it an AI play, Chris. I call it a utility play. I mean, hell, everybody owns Apple. Everybody owns Apple products. I pay Apple every single month. I am on an upgrade plan. Every year I get a new Apple phone. I pay for another Apple phone. Everybody in the United States, at least on my side of the world, it's like a utility play. So you can call it AI if you want. I'll call it utility. You're basically buying a utility stock and selling NVIDIA. I get it. And I think it's a great play, Chris. And it's a nice inverted head and shoulder pattern. And I know you saw it. You wanted to say it, but you're not going to say it on air. But you can whisper it to me later.
To be honest, you can't. Yeah, fine. I mean, it's a set of all it is a set of behaviours, right? And does it lead to a probability? This is why you chuck it into ChatGPT, give you an outcome, mate. How many of you have seen over the last 20 years of these on this pair? What was the probability of it moving? That's why I'm all about ChatGPT.
Oh boy. Oh, okay. We got to move along. All right. So let me give you my play of the day. And this one's an easy one, Chris. If I was sitting next to you, I'd give you one of these. I'd give you a wedgie. I'd be grabbing your underwear and go whoop over your head. No, but this is
I'd enjoy
it. That's scary. All right. So this is the pound kiwi, and I love how buoyant the sterling is, and the kiwi has been outperforming the Aussie for quite some time. So I think that correction is coming a little bit. I think the kiwi's been outperforming a lot. But I think you're seeing this huge trend line that comes back from the beginning of 2023 coming out of the wedge. I think we can rally past the 50 DMA. I think there's some upside here coming out of descending wedges. Descending wedges are my favorite reversal patterns, or ascending wedges. You tend to get a lot of power when you come out of them. It's not like I'm expecting a move back to 220, but I think we can move maybe back to the 215 level, 216, somewhere near that 618. But I don't own the pound New Zealand, but I am looking to buy the pound New Zealand on dips. So I like this one. This is going to be my play of the day, Chris. It is pound New Zealand wedgie. So
tough one at the moment. There's so much like political stuff with Keir Starmer Michaels, mate, and the fiscal situation going forward. But yeah, I mean it's a tough one. I mean you've got they both have their own dynamics, but I love this setup as well. And yeah, I like your play. I'm bored. I would want to buy that. I think that looks good. But yeah, anyway, look, thank you, Blake. I think good to get back in the hot seat with you. Quays did a great job while I was away, and kudos to the lad. And thank you everyone at home for watching and staying on this long. Hit the like button if you can. Tell your mates about it. And we'll see you back next week for more of the trade-off.